Do you struggle with the many different types of investment products available to the average consumer? Have you ever felt that you needed to be a Wall Street veteran or have an MBA from Harvard University just to have a fighting chance of success with all of these different investments? Well, you are certainly not alone. One of the most common questions that I have consistently received over time revolve around the investment world and, in particular, investment products. In today's podcast, I'm going to discuss two of the more common investment products available to the investing public: mutual funds and exchange-traded funds, or ETFs. And hopefully, by the end of our show today, you'll have a much better understanding of the two and how they might fit into your investment plans. Hi, I'm John Gigliello, certified financial planner with the Albany Financial Group, and you're listening to Invest in Knowledge, a podcast about all things financial. After a life-altering health issue at age 39, my calling in life became clear: to share my knowledge of personal finance with people who are looking to make smart and responsible choices with their money. Only through education and action and accountability can you build the confidence and security that you need to live a satisfying life. This month's episode is about helping you to better understand two of the most basic, popular, and misunderstood investment products available. Let's get started. Now, first I want to start out by giving you a general overview of these two investment products. Mutual funds and exchange-traded funds, or ETFs, have been around for years, and they both have a lot in common. Both types of funds consist of a mix of many different assets and represent a popular way for investors to diversify. Unlike purchasing the stock of a single company like, say, Microsoft, where fortunes are driven by the success of the company, mutual funds and ETFs hold many different assets and therefore can offer some form of diversification, one of the key tenets to successful long-term investing. While mutual funds and ETFs are similar in many respects, they also have some key differences. One major difference between the two is that ETFs can be traded intraday during the day like stocks, while mutual funds only can be purchased at the end of each trading day based on a calculated price known as the net asset value, or NAV. More of that to come later in the show. Now, you may have heard the terms active management and passive management when reading about these types of investments. In past years, most mutual funds were actively managed, meaning fund managers made decisions about how to allocate assets in the fund, while ETFs were generally passively managed and tracked market indices, such as the S&P 500, the Dow Jones Industrial Average, the Russell 2000, and the U.S. Aggregate Bond Market Index, or specific sector indices such as the energy sector, the consumer staples sector, the healthcare sector, and the technology sector. That distinction has become blurred in recent years, though, as passive index funds make up a significant proportion of mutual fund assets under management, while there is a growing range of actively managed ETFs available to investors. Now let's take a look at the raw numbers of mutual funds and ETFs. The United States is the world's largest market for mutual funds and ETFs, accounting for a little over 46% of total worldwide assets of $63 trillion in regulated open-end funds as of December 2020. According to the Investment Company Institute, as of December 2020, U.S. registered mutual funds had almost $24 trillion in assets, compared to only $5.4 trillion in assets for U.S. ETFs. At the end of 2020, there were a little over 9,000 mutual funds to choose from and almost 2,300 ETFs to choose from in the United States. Now, some key items to remember about mutual funds and ETFs. Mutual funds were generally actively managed in previous years, with fund managers actively buying and selling securities within the fund in an attempt to beat the market and help investors profit. It is very difficult, however, for a fund portfolio manager or team of managers to consistently outperform some of the popular indices that I mentioned earlier. According to MSNBC, only 26% of actively managed mutual funds beat the returns of their index fund rivals over the last decade through December 2021. Consequently, passively managed index mutual funds have become increasingly popular in recent years. On the other hand, while ETFs were mostly passively managed, as they typically track the market index or a sector subindex, there is a growing number of actively managed ETFs. With an actively managed ETF, the portfolio manager adjusts the investments within the fund as desired while not being subject to the set of rules of tracking an index, like a passively managed ETF attempts to do. The active fund manager aims to beat a benchmark using research and strategies. A major distinction between ETFs and mutual funds is that ETFs can be bought and sold just like stocks, while mutual funds can only be purchased at the end of each trading day. So again, stay tuned for more on that during the show. Actively managed mutual funds tend to have higher fees and higher expense ratios than ETFs, reflecting the higher operating costs involved in active management, such as research staff and trading costs. So, if you are going to pay the higher expense associated with an actively managed mutual fund, you're going to want to do your research to make sure that that fund you are interested in has some track record of beating its index. A common performance measure of distinguishing a manager's performance relative to that of the market is called the Jensen Index or Jensen's Alpha. Speaking of mutual fund expenses, are you baffled by the literal alphabet soup of different mutual fund share classes? While stock classes indicate the number of voting rights per share, mutual fund classes indicate the type and number of fees charged for the shares in a particular fund. Now, I've seen A, B, C shares, I shares, R shares, and even Z share classes. And believe it or not, there's even more than that. Mutual fund companies can have 7 or more classes of shares for a particular fund. However, there are 3 main types of mutual fund classes. They are A, B, and C shares. So let's take a closer look. Let's first take a look at A shares. So A shares charge an upfront sales fee or front-end load that is deducted from your initial investment. Some of the advantages of using A shares are that they have lower 12B1 fees. Now, Class A shares tend to have lower 12B1 fees, which are simply marketing and distribution fees included in the fund's expense ratio. If you plan on holding these shares for several years, then a front-end load might be beneficial in the long run. Breakpoints. These provide a discount off regular front-end load rates each time your investment reaches a certain amount in a series. If the first breakpoint is $25,000, you could invest that amount initially to receive the first discount. Breakpoints clearly favor those with more money to invest. Rights of accumulation. You get a discount on the front-end load if you reach the first breakpoint within subsequent installments of investments. Suppose that the first breakpoint is $25,000, but your initial investment was only $10,000. If you invest another $15,000 to reach the breakpoint, you will receive a discounted front load fee. This is helpful when saving for retirement because working age adults generally are able to invest more year by year. Now, some of the disadvantages of A shares include a high initial investment. Investors who do not have a high enough balance to reach a break point before the deadline indicated by a letter of intent have to pay regular front-end fees. A long time horizon. These funds are not optimal for investors hoping to cash in soon. Suppose that your initial investment is $4,750 after a $250 commission or front load fee has been taken out. And let's suppose your investment increases by 3% during the course of a year. If you sell at the end of the year, in this example, you would have actually lost money. If you take $4,750 times 1.03 and then subtract your initial investment of $5,000, you actually have a $107.50 loss, or a loss of about 2.15%. Now let's take a look at B shares. B shares have a back-end or contingent deferred sales charge. This fee is paid when you sell shares a specified period of years after the original purchase. These shares are typically good for investors with limited cash to invest and a long investment horizon. Now, some of the advantages of B shares would be that there are no front-end fees. Your entire initial investment contribution benefits from capital gains and interest income. That is a substantial benefit for new investors saving for retirement because of the power of compound returns. Consider a stock fund that earns 10% per year over 30 years. The initial investment will be worth over 17 times as much in the end. A few $100s saved in front-end fees means a few $1,000s at retirement time. Another advantage is the deferred sales charge. The longer you hold the shares, the lower your deferred sales charge is. That is another benefit for investors, again, with a long time horizon. And the conversion process. So you can convert B shares to Class A shares, and they automatically convert in many cases over a specific holding period. This conversion is beneficial because Class A shares typically have lower yearly expense ratios than Class B shares. Now, some of the disadvantages for B shares include a long time horizon. It's required. If you withdraw funds within a certain period of time, you're going to be charged a back-end or deferred sales charge. One must typically remain in the fund for 5 to 8 years to avoid that exit fee. With Class B shares, there are no breakpoints. They do not provide breakpoints on the deferred sales charge. Regardless of how much you invest, there is no discount on these charges. That can be a significant drawback for wealthy investors. And Class B shares typically have higher expense ratios than Class A and Class C shares until those shares are eligible to be converted, as I mentioned before, to Class A. Now, lastly, let's take a look at Class C shares. And Class C shares are a type of level load fund, which charges an annual fee. This class works well for individuals who could be redeeming their shares in the short term. Now, some of the pros of owning Class C shares would be that there are no front-end fees. Your entire initial investment contribution earns interest income. There's a small back-end load. The back-end load is typically a modest 1%. And there's an opportunity to avoid back-end loads or sales charges. The back-end load is usually removed after the shares have been held for 1 year. Now, some of the cons of owning Class C shares is the back-end load. A back-end load, although small, is typically charged if funds are withdrawn within the first year. Class C shares have higher expense ratios. Even though the expense ratios of Class C shares are lower than those of Class B shares, they are still higher than those for Class A shares. And there is no conversion. Unlike Class B shares, Class C shares cannot be converted into Class A shares. I know, it's all very confusing, isn't it? That removes any opportunity for lower expense ratios. If you have a long time horizon, Class C shares are not typically for you, as the higher management fees continue indefinitely. In fact, your investment returns will be reduced the longer you stay invested because the fees will just add up over time. And lastly, there are no discounts. Class C shares do not offer discounts on expenses when the account reaches certain levels. Okay, we're on a roll here, so let's take a quick look at some of the finer points of mutual funds. Mutual funds typically come with a higher minimum investment requirement than ETFs. Those minimums can vary depending on the type of fund and company. As mentioned, many mutual funds are actively managed by a fund manager or team making decisions to buy and sell stocks or other securities within that fund in order to beat the market and help their investors profit. These funds usually come at a higher cost, though, since they require substantially more time, effort, and manpower for research and analysis of securities. Purchases and sales of mutual funds take place directly between investors and the fund itself. The price of the fund is not determined until the end of the business day when the net asset value, or NAV, is determined. This is when the fund company subtracts its total liabilities from its total assets to arrive at a value, or again, the net asset value. Now, there are two kinds of mutual funds you should be aware of. There are two legal classifications for these funds. Open-ended, where trading is between investors and the fund, and the number of shares available is limitless. Or closed-end, where the fund issues a set number of shares regardless of investor demand. Both types of mutual funds have been around for quite a while. Closed-end funds are the oldest, having been introduced in the late 19th century. Open-end funds followed in the early 20th century. Now let's take a closer look at open-ended funds. These funds really dominate the mutual fund marketplace in both volume and assets under management. With open-ended funds, the purchase and sale of fund shares take place directly between investors and the fund company. There's no limit to the number of shares the fund can issue. So, as more investors buy into the fund, more shares are issued. Federal regulations require a daily valuation process called marking to market, which subsequently adjusts the fund's per share price to reflect changes in portfolio or the asset value. The value of an individual's shares is not affected by the number of shares outstanding. Today, open-end funds are by far the most popular among individual investors, who often have exposure to them through a 401k plan or 403b plan or some other company-sponsored retirement plan. An open-end fund allows investors to participate in the markets and have a great deal of flexibility regarding how and when they purchase shares. Next, we have closed-end funds. Now, these funds issue only a specific number of shares and do not issue new shares as investor demand grows. Prices are not determined by the net asset value, or NAV, of the fund, but are driven by investor demand. Purchases of shares are often made at a premium or discount to NAV. Closed-end mutual funds may be more volatile. Investors usually need to buy or sell them through a broker and are bound by the market price. But don't confuse a closed-end fund with a closed fund, which is just an open-end fund that no longer accepts new investors. Now, it's important to factor in the different fee structures and tax implications of these two investment choices before deciding if and how they fit into your portfolio. Generally speaking, holding an ETF in a taxable account will generate less tax liabilities than if you held a similarly structured mutual fund in the same account. That is because there is less active trading in the passive ETF versus the actively managed mutual fund. In a tax-qualified account, such as an IRA or a 403b plan, this tax issue is not much of a concern. From the perspective of the IRS, the tax treatment of ETFs and mutual funds are basically the same. Both are subject to capital gains tax and taxation of dividend income in a taxable account. Of course, earnings in a tax-qualified account grow tax-deferred until distributions are taken. At that point, the distribution is taxed as ordinary income. Now let's move on to ETFs. ETFs can cost far less for an entry position, as little as the cost of one share, plus fees or commissions. An ETF is created or redeemed in large lots by institutional investors, and the shares trade throughout the day between investors, just like a stock does. And for those sophisticated investors, ETFs can be sold short, which means that you can borrow an ETF and sell it on the open market. You then purchase it later at a lower price, pocketing the difference after repaying the initial loan. So in essence, you are betting that the value of the ETF will actually go down in order to make a profit. Those provisions are important to traders and, in particular, speculators, but of little interest to long-term investors. But because ETFs are priced continuously by the market, there is the potential for trading to take place at a price other than the true NAV, which may introduce the opportunity for arbitrage. Arbitrage trading is the simultaneous purchase and sale of the same asset in different markets in order to profit from tiny differences in the asset's listed price. ETFs may be more tax efficient to investors in comparison to mutual funds. As passively managed portfolios, ETFs and index funds tend to realize fewer capital gains than actively managed mutual funds. Again, that is because there is far less trading in an ETF than a managed mutual fund. The creation and redemption process of ETFs also distinguishes them from other investment vehicles and provides a number of benefits. This next section is a little tricky, so pay close attention. Creation of the ETF involves buying of all of the underlying securities that constitute the ETF and bundling them into the ETF structure, so to speak. Redemption involves unbundling the ETF back into its individual securities. So what exactly does that mean? Well, the ETF creation and redemption process occurs in the primary market between the ETF sponsor, the ETF issuer, and fund manager that administers and markets the ETF, and authorized participants, or APs, who are U.S. registered broker-dealers that have the right to create and redeem shares of an ETF. The authorized participants assemble the securities included in the ETF in their correct weights, and they deliver those securities to the ETF sponsor. For example, an S&P 500 ETF would require the APs to create the ETF shares by assembling all the S&P 500 stocks based on their weights in the S&P 500 index and delivering them to the ETF sponsor. The ETF sponsor then bundles these securities into the ETF wrapper, so to speak, and delivers the ETF shares to the AP. ETF share creation is generally in large increments, such as 50,000 shares. The new ETF shares are then listed on the secondary market and trade on an exchange, just like stocks. With an ETF redemption, the process is just the opposite of the ETF creation. APs aggregate ETF shares, known as redemption units, in the secondary market and deliver them to the ETF sponsor in exchange for the underlying securities of the ETF. The unique ETF creation and redemption process results in ETF prices tracking their net asset value closely, since the APs monitor demand for an ETF closely and act promptly to reduce significant premiums or discounts to the ETF's NAV. The creation/redemption process also means that the ETF's fund manager does not need to buy or sell the ETF's underlying securities, except when the ETF portfolio has to be rebalanced. Since an ETF redemption is an in-kind transaction, as it involves ETF shares being exchanged for the underlying securities, it is typically tax-exempt and makes ETFs more tax efficient. Now, I know we spent the last couple of minutes here in real detail crawling into the weeds regarding the creation and the redemption process of ETFs. And for the most part, the average investor doesn't really need to be concerned with that. But again, it really is important from a tax perspective. The process of creating and redeeming shares of a mutual fund can trigger capital gains tax liabilities for all shareholders of the mutual fund. But this is less likely to occur for ETF shareholders who are not trading shares. Note that the ETF shareholder is still on the hook for capital gains tax when the ETF shares themselves are sold. However, the investor can choose the timing of such a sale. As I mentioned, ETFs may be more tax efficient than mutual funds because of the way they are created and redeemed. This is really important because we've all had cases in which a mutual fund company issues a large capital gain towards the end of the year, which carries a pretty hefty tax bill at times. Let me give you a quick example of how that hefty tax bill might be created. For example, suppose an investor redeems $50,000 from a traditional Standard & Poor's 500 index fund, the S&P 500 index fund. To pay the investor, the fund must sell $50,000 worth of stock. If appreciated stocks are sold to free up the cash for the investor, the fund captures that capital gain, which is therefore distributed to the shareholders before year end. As a result, shareholders pay the taxes for the turnover within the fund itself. If an ETF shareholder wishes to redeem $50,000, the ETF doesn't sell any stock in the portfolio. Instead, it offers shareholders in-kind redemptions, which limit the possibility of paying capital gains. If you are considering investing in ETFs, I think it's important for you to know the three basic structures of ETFs. So first, let me start with the exchange-traded open-end fund. Now, the vast majority of ETFs are registered under the SEC's Investment Company Act of 1940 as an open-end management company. This ETF structure has specific diversification requirements, as, for example, no more than 5% of the portfolio can be invested in the securities of a single stock. This structure also offers greater portfolio management flexibility compared to the, say, unit investment trust structure, as it's not required to fully replicate an index. Therefore, a number of open-end ETFs use optimization or sampling strategies to replicate an index and match its characteristics rather than owning every single constituent security in that index. Open-end funds are also permitted to reinvest dividends in additional securities until distributions are made to the shareholders. Securities lending is allowed, and for sophisticated investors, derivatives may be used in the fund as well. Next up, we have exchange-traded unit investment trusts, or UITs. Exchange-traded UITs also are governed by the Investment Company Act of 1940, but these must attempt to fully replicate their specific indexes in order to limit tracking error. They must also limit their investments in a single issue to 25% less and set additional weighting limits for diversified and non-diversified funds. UITs do not automatically reinvest dividends, but pay cash dividends quarterly. They are not allowed to engage in securities lending or hold derivatives. Lastly, we have exchange-traded grantor trusts. This is the preferred structure for ETFs that invest in commodities. Such ETFs are structured as grantor trusts, which are registered under the Securities Act of 1933, but not registered under the Investment Company Act of 1940. This type of ETF bears a strong resemblance to a closed-ended fund, but an investor owns the underlying shares in the companies in which the ETF is invested. This includes having the voting rights associated with being a shareholder. The composition of the fund does not change, though. Dividends are not reinvested, but they are paid directly to the shareholders. Investors must trade in 100-share lots. Holding company depository receipts are one example of this type of ETF. So I'm guessing at this point you have questions. Lots of questions. Let me try to anticipate and answer some of those for you. Is it better to invest in the market through a mutual fund or an ETF? The main difference between a mutual fund and an ETF, again, is that the latter has an intraday liquidity feature. So if the ability to trade like a stock is important consideration for you, the ETF may be the better choice. Remember, there are certain tax advantages as well with ETFs. It may be to your benefit to seek out a qualified financial advisor to better guide you on your own unique circumstances. Is there much difference in the fees charged by an ETF or a mutual fund that invest in the same market and have the same passive strategy? The difference in fees is marginal in many cases. For example, some of the biggest and most popular S&P 500 ETFs have an expense ratio about 0.3%. Do the ETFs that invest overseas hedge their currency risk? Well, we really haven't talked about international investments, but yes, many ETFs that invest in overseas markets do hedge their currency risk. So what is currency risk? Currency risk is a form of risk that arises from the change in price of one currency against another. And mutual funds and ETFs use various tools to protect against that risk. Have index funds become more popular in recent years? Index funds, which track the performance of a market index, can be formed as either mutual funds or ETFs. By year-end 2020, total net assets in these two index fund categories had grown to $9.9 trillion, a five-fold increase from $1.9 trillion at the end of 2010. Index mutual funds and index ETFs together accounted for 40% of assets in long-term funds at year-end 2020, doubling their share from 19% a decade earlier. These facts are cited from an article written by Kathy Perito for Investopedia. And there you have it, a comprehensive look at mutual funds and ETFs. I hope you've enjoyed today's podcast, even if you are new to the world of investing. I want to thank and acknowledge Kathy Perito at Kathy Perito and Associates and her article Mutual Funds versus ETFs as the basis of the content of this podcast. If you know of anyone who is struggling with basic investing, please feel free to tell them about this podcast episode. I think they could gain some value from it. Of course, we always encourage you to take part in the comprehensive financial planning process to help secure your financial future and, in turn, feel optimistic and proud about your accomplishments. Knowing that I've provided education and a plan for my clients has allowed me to turn my own personal challenge into a gratifying journey. If you're looking to make smart and responsible choices with your money, then stay tuned for our next episode of Invest in Knowledge coming in early May. Thanks for listening and have a wonderful day. John Gigliello is a registered representative with and securities are offered through LPL Financial, member FINRA SIPC. Investment advice is offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Albany Financial Group are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Any economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. Any examples are completely hypothetical in nature and not representative of any specific situation. Your results will vary. The hypothetical rates of return used do not reflect the deduction of fees and charges inherent to investing. Individual tax and legal matters should be discussed with your tax or legal professional. Investing in mutual funds involves risk, including possible loss of principal. Fund values will fluctuate with market conditions, and it may not achieve its investment objective. ETFs are subject to investment risk as well. Upon redemption, the value of fund shares may be worth more or less than their original cost. ETFs carry additional risk such as not being diversified, possible trading halts, and index tracking errors.